Okay, I'm going to take you through the weekly S&P 500 chart storm here. This is the latest one. For those that don't know, this is something that I do on Twitter. Basically go around and find 10 of the most interesting charts on the US markets and just put them up with a brief take. And this YouTube video is about adding just a little bit more context and commentary behind them. And the covering chart here we've got is pretty much says it all in terms of what happened over the week. And so, with the North Korean sort of back and forward there, we've had a big spike in the Korean VIX, the Korean version of the VIX. So it's going to be interesting to see how we go in trading over the week ahead. Just put a poll up on Twitter here. So following the news and market trading of the last week, this is what you plan to do this week. So, increasing risk, decreasing risk, actively deciding to do nothing or no change. We're just waiting and seeing. And yeah, it's going to be an interesting week ahead. As I've said elsewhere, the North Korean issues could be the catalyst, could be just the catalyst that the market needed. Because, you could argue that a correction's been overdue. So into the first one, one argument that a correction's overdue is that across a few different measures, we've seen bearish divergence. So you can see lower highs rather on the average RSI across all of the S&P 500 stocks. So rather than this being the RSI of the S&P 500 itself, this is the average across all the individual stocks. One thing I would note is that that's already looking fairly oversold. So that's one piece of information. On to the next one, again, going back to the cover chart. This is the Korean VIX, or the Kospi VIX, superimposed against the traditional S&P 500 VIX. That there's quite a few moments of departure between the two on the chart, but it'll be interesting to see how things go. With this sort of thing, you kind of need to see an elevation of things, or sort of follow through of the scary news that sort of helped to drive it in the first place. I mean, there's definitely a case to be made that there should be higher risk pricing in general now, but the age-old issue of what's bluster versus what's gonna actually, what's bluster and bluffing versus actually what's going to happen. We'll probably see both of these settle down in short order, unless, again, as I said, that this turns out to be the catalyst for just a larger sell-off and de-risking, a bit of an excuse to take profits. And on that front, it's been a very calm year. And so what this table is showing is the number of down days which exceeded 1% and the number of up days which exceeded 1%. And so far this year we've had 3 down days that exceeded 1%. And you have to go back quite a bit to actually find a year where you had this kind of low volatility. And there is actually precedent. So if you look at the early 60s, there was 2 years there where volatility was extremely low, as measured by this gauge. And I've taken this a step further. This is a chart that I've done previously, and it tracks the number of moves exceeding 1% plus or minus across a rolling 12-month period. And you can see there that it's at a 22-year low. It did actually tick up following Thursday's move, which is down 1.4%. So, I would say that this looks to be at a cyclical low. The process of actually completing that low can take some time, as we saw there and there. But, I think probably the one thing to take away from this chart is, not so much where it gets to, which can be quite important, but also what it does. So when it starts to turn, that can be quite important. Interesting anyway. And I guess on the issue of the topic of volatility, this here chart is from Mark Arbiter, a very very well worth following account. And what he's pointed out here, and this is another measure of volatility, is the 1 month rate of change. And what he's identified here or noticed is this trend or tendency that you tend to see contracting volatility in the early stages or the first part of the bull market or market cycle. And towards the end of the market cycle, you tend to see a widening up or, an increasing of volatility. We haven't really seen that yet. Maybe we have. Maybe this is a shot across the bow, but this is very, very much sort of rule of thumb or an interesting chart to note. This one here comes from the Chart Critic series that we're doing on Top Down Charts blog. And there was another version of this chart posted where it was actually, the snapshot was taken from this period here, and it showed gold, far exceeding the S&P 500. And it really, one of my key points on this chart is, or that article specifically, is that the starting point can have a huge bearing on what, the conclusion you end up making in terms of which one outperformed. Because, if you take the snapshot here, it shows S&P 500 well ahead. And yeah, well, I guess the comment that I've made here too is that, gold can be a good hedge, but, don't put all your eggs in one basket. So this one here is the equity risk premium calculated by PIMCO. And what they've got is the cyclically adjusted earnings yield minus the 10-year real yield. And you can see there that it's crossed over from, above average levels to now just below average levels. It's nothing, it's still quite far away from the 07 peak. And it's very much quite far away from the all-time low that it got to around the dot-com bubble peak. So, it's not, as I said in the tweet, it's not pretty, not ugly, but, as it does depart further below that average line, it'll, it just reflects that you're getting a lower equity risk premium. Number 7. So this one is from FactSet, and it shows in the green bar the companies with less than half of their sales in the US, and the implication of that is that they get most of their sales from offshore. And the light blue line on the other side there is companies that get most of their revenue in America. And you can see there that there's a clear departure. The ones with the majority of their sales outside of US are doing the best. And there's, we can speculate on a number of different reasons for that. On the issue or the topic of profitability, earnings, this one is the return on equity. And this is comparing return on equity across America, emerging markets, and developed markets ex-US. You can see there that on all fronts they've made a synchronized upturn. I've talked about this in more detail in the article there, and in even more detail in a previous edition of the weekly macro themes. We looked at the actual, what they call a DuPont breakdown analysis, where you break down return on equity, first of all, into return on assets and equity multiplier or leverage, and then you split return on average on assets into profit margin and sales turnover ratio. And it is actually quite a different story across the three different regions that we're comparing here. But it's interesting to note that the two ones out on top here. So first of all, America, the one with the best one, this is the one that's also the most expensive. But emerging markets are not actually that far off, and they're the cheapest. And probably the other thing to note on emerging markets is it's still quite a bit lower. And one thing I did point out in that article is that the leverage or the equity multiplier for emerging markets has gone up quite a lot since back then. And what that actually means is that you actually need less improvement in profitability to achieve the same improvement in return on equity. And return on equity is the thing that's really important for equity investors. So that's it's something that another thing that can sort of go in favor of emerging markets. Hedge funds and risk. So this chart, there's not really a whole lot to say about it. It's just sort of comparing, and I say sort of comparing because they're on different axes. So take that with a bit of a grain of salt. But you can see that the trajectory of the funds of funds composite there versus the trajectory of the S&P 500. Very very much different assets there. Final one is this very interesting chart and it was shared by Teddy Valley, and the red line there is what you get if you sell on the full moon and buy on the new moon, and that yellow line at the bottom is what you get if you do the opposite. So it's quite interesting. I don't know whether it's just there might have just been a bit of luck involved in that. Certainly it hasn't been performing as well as it arguably has been in the past lately. But it's just another interesting quirk in markets. Another sort of another interesting quirk is that whole sell in May, come back in October trend. But I guess it's just another, probably more one to go in the interesting category than one to sort of feed into your investment strategy as such. So look, I'll leave it at there, and if you had any questions, comments about this, go ahead and put them into the comments section of the YouTube video, and be sure to subscribe to the channel. I'll be putting out another piece of commentary later in the week